Good morning, everyone. Welcome back to Your Money Matters. I am Angela Giroux, publisher of the Bauman Letter, and Ted Bauman is back with us today. Welcome back, Ted.
Yep.
And of course, we've got Clint Lee, research analyst. Good morning, Clint.
Good morning. Hello, everyone.
Now, we're recording this on Monday, and we know it's set to premiere on Wednesday, but it's a very big week in the markets. Facebook announced today that they would actually delay their earnings release until Thursday, and that means they'll be releasing their earnings along with Apple, Amazon, Alphabet. So it's a big day. No matter what the news is, if it's negative, positive, it's sure to impact the markets. And Ted, you've got a great chart that actually illustrates just why that is.
Yes, let's have a look at that chart. It shows that right now the top 5 companies in the S&P 500, which includes those and plus Microsoft, which is already reported at one point were over 22% of the total market capitalization of the S&P 500. That's the biggest figure that I've seen historically, and it's certainly the biggest concentration of tech. So, I mean, clearly this is a big day because we're looking at roughly 20% or more of the U.S. Corporate sector by value reporting their earnings. So yes, that's a pretty big day. And I think, it's something that everybody's going to be paying close attention to. It's interesting that Facebook decided to shift to Wednesday. I guess they thought, it would be maybe they'll get lost in the mix or something. But Clint, I know you've talked about the historical relationship between, these big, because they're really growth companies, right? I mean, they are given supreme valuations, high valuations, because they're expected to grow in the future. Can they keep doing that, Clint? What does the historical record say?
Yeah, the historical record actually paints a bit of a different picture. Like you mentioned, the top 5 companies in the S&P right now and kind of what it's pushed that index weight up to are all growth companies, and we've been kind of conditioned over the last decade, really, and especially this year is just kind of the icing on the cake in terms of being conditioned to expect that growth always outperforms, especially outperforms value. Mm-hmm. But when you actually look at the relationship between a growth index and a value index, and you run it back over a larger historical period, the picture starts to change quite a bit. And one of the charts I want to highlight, and I'll show right here, this looks at a value index compared to a growth index going back to the mid-1920s. Now, this comes to us from Eric Nelson via his Survey Wealth blog. And what you can see here is the blue line is actually the value index against the green line being the growth index. And over this time frame, the annualized return of the value index has been about 12.75%. Versus about 9.6 or 9.7 for the growth index. So over a longer stretch, value actually tends to do better than what a growth index does, despite, that includes what's happened over this past decade, where the performance has been the other way. Now, I know one of the things we talk about a lot, Ted, is needing to see a trade-off, sort of a change in leadership, and you want to see the baton be handed back to the value space. And it's hard to pinpoint when exactly that'll occur, but I know one of the things we watch closely is valuations between a growth index and value index, or growth index and value index. And that's the next chart I want to show. This shows the price to book ratio for growth versus value. Now, it's just a valuation measure like price to earnings, except book value is just a company's assets minus its liabilities. And this again takes those ratios back over that full historical time frame. I think what really stands out to me is these sharp spikes higher in the growth price to book. So that lighter blue line, you can see the quick moves higher. That's sort of that speculative frenzy, like what we're seeing right now. And then you see these absolute collapses. And we're right now in one of those time periods where the spread between the growth and the value valuations is as wide, if not wider, than what it was during the tech bubble. The darker blue line on here being the value price to book actually is trading a little bit below its historical average versus having this big run up higher in growth valuations.
We've been talking about that a bit, Ted. I know you were just writing about this in Bauman Daily about how there eventually will be this sort of changing of the guard.
Well, yeah, and in fact, I just want to point out, if you subscribe to the Bauman letter, click on the link up here, you'll note that a lot of our strategies this year have actually been based on trying to capture value rather than chasing growth. And that's for a specific reason. And here's some of my logic behind it. I mean, fundamentally, there are a couple of things that are just completely different now compared to where we were, say, even in the dot-com bubble. The dot-com period was pure speculation. People were buying companies as long as they, had a website because they thought that this was going to be the next big thing. They were right, but they were early by about 10 years. And really, there was no justification for those valuations. They really, in a sense, weren't growth stocks. Maybe in some ways, they were kind of momentum stocks because people were buying the stocks because everybody else was buying them. Now people buy these growth stocks because they assume that these are huge, powerful companies that are like vacuum cleaners for money. They suck in money. They have huge revenues. They dominate their industries. Nobody can compete with them. And they expect them to continue to grow because of that. And as a result, they reward them with higher multiples, that they're willing to pay higher prices for earnings. But the problem is that we've got to the point where, they're stretched out. I mean, as I said yesterday, how much higher can those multiples go? How much higher are institutional investors like pension funds and hedge funds willing to see them go? Because eventually they get to the point where they can't absorb any more of that stock in their portfolios. It's too much. They have to start selling it to rebalance their portfolios. But the most important thing to me is this. These companies made money over the last 10 years in an historically weak global economy because they are very low capital. They don't require a lot of employment even. Their main assets are their intellectual property, things like software that is not physical. And so they were able to make a lot of money even where the global economy had slowed down to about half its long-term growth rate. Now, at some point, we expect the global economy to begin to return to rapid growth, especially after the big knockdown that we've just seen. What that means is, where's all the rapid growth in stock prices going to come? It's not going to come from these guys. It's going to come from everybody else who's been sitting on the sidelines for a decade, waiting for an opportunity, to see their prices bid up again. Brick and mortar companies that make automobiles and for consumer goods and all that sort of stuff. So I think we're set up for a big rotation. That's where we need to be putting our money to prepare for it, because once it happens, it's too late.
Where should we put our money?
Well, I think basically, we don't recommend specific companies in
Right.
these YouTube videos. We do in the Bauman letter, of course, which is our business. But I think right now, one of the key things for me is to look at ETFs that have really, they've kind of dawdled along. They've traded sideways, like VTV is one. Another one is IJS. They're basically value and small mid-cap ETFs. It's VTV and IJS. There's just two, but basically the idea is that they're trundling along, they're trading in a sideways pattern, but when the economy starts to pick up and people realize that, they're going to start buying all the companies that comprise these. They're not going to go back and start buying more shares of Amazon, because presumably Amazon's going to back off a bit when the economy recovers, right? Because people will start going out to shops again. So you want to be positioned in those kinds of places, I think, going forward. And it's something that we've said earlier. In relation to global versus US stocks, you want to, the stock market is forward looking, but not everything can be seen unless you think about it. And here what we're saying is that what you might miss if you're not careful is that there's going to be rotation, and that's where the real money is going to be made.
All right. Clint, anything else to add to that?
I think just the other thing I would add is that even if you start to, we talk about the tech bubble, people start becoming fearful because of the collapse in share prices, especially in those higher growth names. But it doesn't necessarily mean you can't find better performance elsewhere. It doesn't mean throughout that whole episode, using the tech bubble as an example, that you didn't see other areas of the market do well. To Ted's point, there were areas like small cap value that at one point, right in the middle of the tech bubble busting, small cap value was up something like on magnitude of 40%. And so while the indexes might get dragged lower because these high growth tech stocks make up such a big weighting, it doesn't mean you can't find opportunities elsewhere.
Yeah, and I think that's exactly the point, is that, we, in the aftermath of the tech bubble, by comparison, what happened is that people were looking for yield, and they knew they weren't going to get it in the growth stocks. They weren't going to get it in those dot-com stocks that had failed. So they went pouring in looking for yield elsewhere. Because remember, a lot of what happens in a rotation is simply people shifting money from one type of stock to another, because that's where they perceive the yield is going to be, and it becomes a self-fulfilling prophecy. And to an extent, algorithms get built around following those kinds of trends, and then that piles on. And I think that's what we should be looking for sometime, hopefully early next year. But a lot of it depends on, of course, the virus.
All right, great. Well, as a reminder, Ted will be back on Friday with another video. And at that point, you'll have more information in your hands that you could follow up with this.
Yes, we will know how the biggies responded in terms of earnings to the first and second quarter, but we will also know how the stock market responded. I've learned the hard way. It's tough when you make predictions, but it's quite possible that some of these companies could see significant declines after earnings, even if they report well, because of this perception that this maybe is as good as it gets. And when that happens, people look elsewhere, and that's exactly the point we're making today.
Great, then we will follow up on Friday. Thank you so much for watching. As Ted said earlier, if you want information about the Bauman letter, click up on the left hand of the screen. If you want to subscribe to our free e-letter, Bauman Daily, there's a link below. And that'll do it for us today. Thank you, gentlemen.
Thank you.
Thanks.